welcome to this Q1 2026 Market Perspectives video. My name is Andrew Krei. I'm the Co-Chief Investment Officer here at Crescent Grove Advisors. On behalf of my colleagues and myself, as always, we appreciate you taking some time to watch these videos. I do want to note at the outset that we're recording this on April 7th, just with everything moving so quickly as it relates to the Iranian conflict and capital markets. We just wanted to make note of that the data you're seeing is either as of the end of Q1 or as of yesterday's market close, as it's noted on the charts. So for this video, we're certainly going to talk about the Iranian conflict, all the first order, second, and third order effects of that conflict. And we'll look at a couple different dimensions as we move forward here that certainly can be top of mind for investors, whether that's the Fed, whether that's valuations or earnings expectations. We'll unpack all of those as we go through the charts here. So with that, we'll jump right in. So the Strait of Hormuz is really the epicenter of what we've seen with this Iranian conflict. And for obvious reasons, as we illustrate on this page, so much of the world's energy and fertilizer supplies go through the strait, and we've seen traffic effectively decline to zero as it relates to shipping traffic moving through the strait at this point. That, of course, is the first order effect. That's the oil price spiking. That's other areas of the commodity complex seeing prices spike in this environment. Certainly top of mind for investors at this point. And again, has a cascading set of effects as you think about capital markets around the world. Now, what's been interesting, if you look at stock markets, if you look at bond markets, it's been pretty well behaved. So as we illustrate on this chart, we've seen commodity prices spike. And certainly if you take a broad index of commodity prices, as we're illustrating here, up about 24% in Q1. But then if you start to look through other segments of the global market, whether that's US value stocks actually being up for the quarter in Q1, or the S&P 500 only down about 4% relative to, I think, what we've seen from a headline, sort of risk perspective, what we've seen as it relates to the bellicose rhetoric that's come out of Washington and elsewhere. We haven't seen as much of a market reaction, I would say, versus, again, kind of what perhaps might be perceived based on the headlines. And alongside that, as we're illustrating on this page as well, is you actually haven't really seen the odds of a ceasefire move up meaningfully. So we're showing polymarket odds, which is a prediction market, but looking at either a ceasefire at the end of April, May, or June, looking at that, you're talking about 30 to 60% probability. So far from a certainty, but again, nonetheless, capital markets have been pretty well behaved in the face of what seems to be potentially a protracted conflict. Now, one of the reasons that US stocks in particular have held up well, and as we're showing on this chart here, is over the years, the US has really kind of insulated itself, not only from an energy independence perspective, so we don't have nearly the kind of acute energy shock risk of a country like a Japan or a Korea, but also as a function of the sort of consumer spending basket. What we've seen is that the cost of energy has come down significantly on a percentage basis, right? So just your average household is spending less as a percentage of their disposable income, of their household income today than they were several years ago. And if you think about what's been driving growth in the US in particular over the last several years, it's been those sort of upper quintiles of the wealth distribution, the income distribution, and that's ultimately a pretty small percentage of their budget going towards energy. So I think stands to reason why the US, again, has held up pretty well, and perhaps there's a little bit of a insulating mechanism there as it relates to higher energy prices on the US economy. Now, I think if we take a look at some of the elements that we want to watch going forward, and we're certainly alongside other market participants closely watching the Fed, first and foremost, and thinking about how are they going to react in an environment where inflation is moving higher, but ultimately there is a risk that that tips into more of a growth shock, where you get demand destruction because inflation has moved so high. So as we show on this page, on the upper right, we came into the year expecting that the Fed was going to cut rates, call it 2 times in 2026, 2 25 basis point cuts. Again, as inflation expectations have moved higher alongside higher commodity prices, what we've seen is those cuts have been priced out of the market. And at this point, you've got the market expecting close to a 3% CPI figure on a consensus basis for full year 2026. That's at odds with the Fed's 2% target for inflation. The question that we're posing here, though, and I think that has to be on the minds of investors, is when does this go strictly from an inflation story, though, to this demand destruction story, where you see a protracted conflict, you see energy prices and oil prices in particular, as we illustrate on the left side of the page here, perhaps going into this $130 to $150 per barrel range. When does that then migrate into a demand destruction story? And then how does the Fed navigate that in terms of thinking, well, all of a sudden they have to start considering cutting interest rates to support the growth side of their mandate, which is effectively a full labor market, full employment type of backdrop. So the Fed is in a bind. We're going to closely watch how they navigate this period going forward because, again, it's going to have clear impacts on not only the bond market, but then derivative impacts on the equity markets as well. As it relates to equity markets, one of the things we have been flagging now for several quarters was just the elevated valuations within the growth segment of U.S. markets in particular. So the Magnificent Seven, those big mega cap tech names that have been trading at pretty elevated multiples relative to any sort of historical measure. And what we've seen and what we're showing on this chart here on the left side is that we've had a real correction in those multiples. And in particular in Q1, you saw a meaningful derating within the growth segment of the US market back towards, call it 20-year median type levels. Not quite there, but headed in that direction. You saw that also across other dimensions, whether that's US value stocks or non-US stocks, seeing a little bit of derating, but they weren't trading at such an elevated level to begin with. What's more interesting though is, again, we think about all these second, third order effects and start to unpack things a little bit more deeper. What you see on the right side here is the average stock across these different indices, whether that's US growth, US value, non-US markets, is actually down much more than the headline level. Just giving you some sense that there's been a lot of churn beneath the surface. There's been more pain perhaps than the headline index levels suggest, which perhaps creates some opportunity then if you're buying in at slightly lower valuations, or in some cases, materially lower valuations as it relates to growth stocks. And then you're also buying an index that's full of names that have been a little bit more beat up than perhaps the top holdings in those indices. So certainly something to watch going forward and perhaps an area of opportunity that investors can take advantage of. So the other side of the coin as it relates to this valuation derating that we saw, kind of that movement back towards long-term medians for price to earnings ratios, is that we still have a pretty elevated E in the PE ratio. So the earnings expectations as we came into this year were pretty elevated. Investors were seeing meaningful growth on the horizon, not only for US markets, but then if you look at non-US markets, as we illustrated on this chart, emerging markets expected to grow earnings over 30% this year. And what we saw for the US, as we point out here for the S&P 500 on the right side of the page, is that earnings expectations as we moved into 2026 on a quarter by quarter basis were actually above where we came in last year. So we had pretty low expectations, the market beat, and now we've raised the bar pretty significantly as we've moved into 2026. So I think the question becomes, yes, you're paying a lower PE multiple on these stocks, but is that earnings number, the E and the PE ratio, going to hold up this year? Or will we start to see some of these growth concerns, some of the inflationary effects that we talked about as it related to the conflict and the global commodity market sort of price spike? Are we going to see those flow through into lower earnings expectations going forward, in which case those earnings, the PE multiples didn't really derate that much after all because the E is actually lower. So you're still paying a similar valuation to where you were before. That, I think, becomes a big risk for investors and something to watch going forward, and as we perhaps navigate this inflation to demand destruction to growth concerns handoff. All right, we'll leave it at that for this quarter's video. Again, my name is Andrew Krei. Thanks for watching.